If I gave you the choice of whether to invest in two different investments based on their past performance, which one are you likely to choose? It's a pretty obvious answer, as you want this one here with the best returns, as it looks like it's heading to the moon. There's no good reason why you'd pick this one. Why would you ever want to make less money? Now, what's the catch? What happens if you chose this one here, and how does this story end? Well, here's what happened next, and all of you who picked this amazing investment would be asking yourself some very difficult questions right now. Or you may have already sold a long time ago and moved on to something else. In the stock market right now and throughout the past, this story has played out hundreds and thousands of times before, and I bet that this pattern continues forever. Now, if you want to avoid making the same mistakes as everyone else does, keep watching this video. So in that first example, you might just think, Toby, you've just cherry-picked two different investments to make a point, as that's just investing in hindsight. And you'd be right, I have just picked one example here. But the reality is that this plays out time and time again throughout history. Let me zoom out for a second and show you the first bit of interesting data. Many of you would have seen this before, but this is BlackRock's heat map, and it shows which type of investment has performed well each year. Now, each color represents a type of investment. For example, you can see stocks in green, bonds in yellow, and then commodities and private equity in orange. Now, generally, if you just take any year, you'll see that it's anyone's guess what can happen. One year, Chinese stocks might be the best. The next year, commodities like oil will beat everything else. Or you might even have cash winning like it did here in 2018. Quite honestly, you'd be gambling if you could make any kind of prediction as to what will happen in any given year. Now, let me just take this one step further, as this will help kind of make the point I was hinting at earlier. Let's zoom into 2022 and see here that the best performing type of investment was commodities. Remember that commodities are anything from gold, oil, lumber, and even things like coffee too. These are huge markets, and so many things can affect the price of these commodities at any given time, and they are highly unpredictable. Nevertheless, investors are still going to want a piece of it. Here on screen now is how much investors piled into commodity funds during 2022. As you can see, up until March, there were huge inflows. In a single month, it peaked over $10 billion. Then, for the rest of the year, from May onwards, money was pulled out. In hindsight, now that we know commodities were the best performing asset over the whole year, surely it would have been better just to get your money in and leave it there. The truth, I think, lies one layer deeper. This next part for me explains this point perfectly. If I look at the performance of one of the largest commodity funds you can invest in, and then I see what happened month by month in 2022, this explains everything. As you can see, 2022 started really strong, and all throughout January to April, things were in the green. Then from May onwards, the road was a bit more rocky and things didn't look good. Now, this ties in exactly with the way investors behaved. They literally threw money in when the performance was high and pulled money out when the performance was looking bad. And to make things worse, if they just held on and not done anything, they would have actually been investing in the best performing asset type of that year. What was the big mistake? Chasing performance based on the most recent past. It's happening right now, and it will almost always happen moving forward into the future. Let me show you some more interesting examples first, though, before explaining how you might be able to avoid making the same mistakes moving forward. In this study called Slow and Steady Wins the Race, the authors looked at the performance of investment funds over the long term to see the relationship between risk and returns. They followed the performance of different funds to see if the riskiest ones managed to stay on top. Now, the results are pretty interesting here, and there's a few interesting bits that they learned along the way. Firstly, remember that in the investing world, fund managers are trying to get as much money as possible to manage because their fees are based on the percentage of what they manage. Now, to do this, the research points out accurately that fund managers attract all of the new money by showing the world just how great they are, and they focus on being in that top percentage of funds by performance. However, just like we saw earlier, this short-term focus on gains can have much longer-term issues. You see, as the managers try to do more and more risky moves to try and put themselves at the top, what ends up happening is that their long-term returns end up worse than they could have been. In the conclusion to this long-term study, the results show that the funds, which were slightly less risky, actually ended up performing better than the funds that went for the most risky strategy. Here you can see that over 60 years, the funds that are in the risky category actually managed to stay in the first quartile more often. The first quartile means that they ended up in the top 25% of all funds in their group. And this is often where the managers want to end up because, as you might guess from earlier, if you end up here, investors are more likely to choose you to invest with. However, just a word of caution here from this study. Although they conclude that in order to be successful, you're better off being a fund manager who aims to be in the second quartile rather than chase the top dogs, all of these funds were passive ones. This research doesn't even factor in the active managers who you're about to see are even worse when it comes to chasing performance. If we now look at the latest research from S&P Global, we'll be able to see just how many investment funds show consistent performance to their investors. To be honest, none of this surprises me, but it may shock you a little bit if you've never come across this information before. Basically, the researchers take thousands of funds and look to see which ones stay in that top 25% of funds and how many actually survive the journey over the years. The first shocking thing you'll see is this one. A large number of funds either get merged or liquidated and never even make it. And it won't surprise you that the biggest reason for funds being closed is based on their performance. Here, it shows you that of the funds who performed the worst between 2013 and 2018, over the next 5 years, 36% of the worst performing funds would end up liquidated or merged. Also, what I find quite interesting as well is that even for the funds that performed great over that same 5-year time frame, 18% of those funds still ended up merged or liquidated over the following 5 years. Now, here's the most important part for me, and if that bit surprised you, you're going to be in for a shock when you really take a look at this. So let's assume that you're a newer investor and you want to get the best returns. I can't blame you really, that's what we all want. You see a fund that looks great, it's well diversified and it's done well at least for the last year. Now, you invest your money and then wait, as that's what you've been told to do if you want to make money. You hold them for a long run and you don't look back. Well, assuming you did that, here's the chance of that top performing fund to stay a top performing fund over 5 consecutive years. This table has all of the funds that were tracked here from December 2019 up until December 2023. And they're broken down depending on what area of the world they chose to invest in. Shall we see what percentage of funds managed to make it out alive for 5 years in a row? Okay, here goes. In Europe equity, the percentage of funds that remained was 0. For Eurozone equity, the percentage of funds was 0. For global funds, I hope this gets better. Surely there has to be some winners out there. Here, the number is 0.7%, which would mean that out of 286 funds, just 2 funds kept in the top group. Now, emerging market funds, surely here you might expect some great results here, right? Lots of expertise working hard to beat the market and find great opportunities. Well, the number that ended up at the top were 0. Sorry. What about the US then? The home of the largest stock market in the world, the home of innovation and amazing companies. Surely, out of 81 funds, we must have seen some top performers here. And sorry, it's also a 0. UK funds too, that's a 0 as well. Now, this isn't to say those funds didn't have a good final return number, it's just that they weren't consistent with their returns over that period. And this was the point I really wanted to highlight for you here in this data. If you do want those great stock market returns, there's no way to tell the future returns based on the most recent performance. That phrase that you see in the disclaimers that says past performance is not a reliable indicator for future performance is true, and it's there for a reason. Now, what about present day? Well, right now, all the hype is around AI and pretty much all of the big tech names that fall into the Magnificent Seven. Anyone who makes chips, talks about data centers or robotics is getting some premium pricing and attracting lots of money from investors. Big names like Nvidia have soared more than 190% over the last 12 months alone, making it one of the most valuable companies on the planet. All of this has been backed up by great results too. It's not just hype. All of the numbers are great. It's not the dot-com bubble where valuations are just made up. But regardless of this past performance, as investors, we're only really interested in the future. That lovely chart that you can look at for Nvidia is totally irrelevant if you're a brand new investor today because you can't go back in time. And what you really want to know is how your investment will look in the future. Now, if we knew that, we'd all be multi-billionaires. So the big question is, what do we do about it and how can we avoid getting sucked into the hype? Well, it's first worth saying that there is no way of knowing what's hype and what's real right now because, yet again, that is trying to predict the future. And the last time I checked, that is still something that is not predictable. The market is our best guess at any one moment of what something is worth. You can argue all you like about whether it's expensive or not, but this is where we're at. I think the temptation right now is to look at some of the best performing funds and stocks and say, Why am I bothering to invest in a global index fund or the S&P 500 when I can just have technology or AI instead? There are popular funds that invest in the Nasdaq 100 like the QQQ that have massively outperformed the S&P 500 recently. So why bother with the S&P 500 anymore? And it's the same with some other areas too. There's loads of technology-focused ETFs and funds that have done really well based on their past performance. Surely technology isn't slowing down at all, so why not just ditch the diversified boring investments and go all in with those? I can easily see why people would come to that conclusion, and I know the feeling that you want to make the most of your money and get the best returns. This is what most of us want, right? Because if we make the best investing decisions, then we can have potential, huge potential, to change our lives and maybe even do something like retire early. The issue is that none of this recent past performance truly matters if you are a long-term investor. And there is no way to know if a recent outperformance is going to continue into the future. My own personal view would be that if you choose to invest this way, you're going to have a very stressful investing life because you're always going to be jumping from one thing to the next, hoping that you've finally found the next big thing. And mark my words, there will always be a next big thing. We might not know what it is yet, or what the company is, or even whether the company's been created yet, but you can guarantee that there will always be plenty of next big things in the future. So, what's the solution? Well, for me, it boils down to the basics that many of you will already be well familiar with. Keep your investing simple. So, for me, that would mean low-cost, well-diversified index funds. Invest regularly no matter what. That way, you'll buy at the lows, the highs, and everything in between. And finally, you have to do this for a very long time. Everyone says they're a long-term investor, but being one is much easier said than done. For me, long-term is measured in decades rather than just a few years, because in just a few years, anything can happen. To be successful without gambling on an individual company, you have to stick with this for the long term. It's exactly the same with anything you want to do in life, whether it's to get fit or change your diet. Unfortunately, most people won't do it, but if you can stomach it, the results can be amazing. Anyway, hit the like button on the way out, and as always, happy investing.